Hey, coconuts! Yes, breaking news. There's a lot of things going on about China's stocks delisting and all the pressure, all the volatility. A lot of you are concerned, and I've received a lot of DMs. I mean, even on Telegram, people are talking about it. So, yes, with all these concern, I want to share with you my perspective, share with you my thoughts about Chinese stocks delisting in the US market. I will say it's not a risk, it is a new reality, huh? So I know. Wow, tagline statements, a lot to unpack. And I'm gonna share with you my thoughts about how has this changed, how has the relationship between Chinese companies and the U.S. markets changed over time, and why you are seeing the Chinese government pressuring some of these Chinese companies to list back in China. So that is a lot of interesting stuff to talk about. I'll try to keep it as simple as possible for you to understand what is the situation, how to play this situation. But yeah, it's a much bigger, ginormous situation than you want to understand, and the media is covering. So yes, breaking news. Welcome back. Good morning, everyone. I welcome you to another day with the Financial Coconut. In our podcast, debunking financial myths, discovering best financial practices, and discussing financial strategies that fits a unique life. You get it, ultimately empowering us to create a life we love for managing our finances well. My name is Reggie. I am your host and your chief financial coconut. And today we're going to focus a little bit on China's stocks delisting. To me, it's not a risk. It is a little bit of a new reality, right? It's not as risky as what the media wants to make it sound like. Okay, so yeah, welcome back. Okay, so there's a lot of angles to look at this thing, and I know the mainstream media is always hyping it. Oh no, China pressure the company to delist, right? So it's a it's a lot of that kind of stuff where they're trying to make it sound like the Chinese government is authoritarian. They want to delist the companies. They don't want it to raise money. They don't want these companies to prosper and do well. So they want to do a lot of this kind of stuff, right? But actually, if you think about it, it's not exactly like what they're saying. They are not trying to get companies not to list. In fact, the Chinese governments have opened up multiple stock market, right? I think they have like 5-tier stock market at this point in time, right? New York has like what, NASDAQ, NYSE. Singapore has what, SGX. Do we even have a smaller stock board? I don't know. but yeah, you get the idea, right? So China is embracing capital markets, is embracing this whole stock market reality where you have the financial market movements, you get the volatility, you allow companies to raise money from the public to the markets, and what have you, right? So China is not against financial engineering, or I would say raising money, or even like having big companies do well and make money. Okay, China's not against that, but China wants it to be in their own soil. So it has changed. Okay, it has definitely changed. So when incentives change, of course, strategies will change, and that is the reality that we have to embrace with China trying to rise and compete with the US. So this is definitely the new frontier of competition, competing for its currency, competing for its markets. It's not a new thing, it's an extension of the ongoing dispute between US and China. But it is not like anti-business or anti-cooperation or anti-financials. No, right? So they are still open and welcoming, retail investors to own Chinese companies, but they want you to own it in China, right? They don't want you to own it in the US. It's different. But I would say whatever the mainstream media is saying is not totally baseless. Do you think Didi is getting pressured by the Chinese government to delist in the US and list back in China? Of course. It's one of those new age company that just recently got listed, although the Chinese government said no, right? So Didi is definitely getting political pressure to list back in China, I will say. But why Didi, then why not the other companies, right? Because I think that's the ongoing concern. Like, is this going to be a slippery slope? Is Meituan, Tencent, Alibaba, JD, everybody going to delist from the US? How is it going to affect me? I think that's people's main concern, right? So we will talk a little bit about this as we go along, but I will say why TT, because firstly, TT is a relatively young company, relatively young as in listed in the US. So it's not very entrenched in a lot of big indexes yet. It's not very entrenched in industry portfolios or institutional portfolios. And it is an interesting growth company that China wants to own back in its own soil, right? So you can see it in a more political angle when you look at TT. It's more like, okay, this company is like young and new, not very in the big pockets of the big financial companies yet, so the pain will not be as bad, the backlash will not be as crazy. They will not force Alibaba to delist or force Tencent to delist, right? But they will execute some pressure on TT, which you see it, they're going to delist it, and they're going to list TT back in Hong Kong or back in Shanghai, right? So what I predict, this is a prediction, okay? You can come back to me a few months later and we'll see if this works. What I predict is that after TT delist from the US and go to Hong Kong or Shanghai to list, the institutional investors in Shanghai, in Hong Kong, that means the local capital in China, will bid it up even higher than what happened in the US. Right, so this becomes a carrot and stick situation, right? So you tell Didi, don't list in the US, come back home and list at home. Right, so when they list in Hong Kong or list in Shanghai, depending on where they list, China will very likely ask institutional investors or incentivize institutional investors to bid it up. And in that sense, it kind of becomes an incentive where, some of these other Chinese companies will automatically or be incentivized to say, maybe we can list back in China, don't need to list in the US anymore, right? So it's a little bit of a carrot and stick. I believe this is where it will be. You can mark my words, right? And we shall see in a few months, how does this play out? And so today I've gathered a few points for you. I will not say that they are like correlated or very organized. It will be a few scattered points to answer some of your scattered concerns around China's stock delisting and why I think it is not a risk but a new reality. Okay, so let's begin. The very first point that I think all of us should know and be aware of is that in the past, Chinese companies list in the US because the Chinese financial markets are very weak. So they have no money essentially to invest in some of these high-tech growth companies. Okay, so it is still seen around the world. All the biggest tech companies or the biggest growth companies, or in other words, the companies that want to create a future, but now they are still nothing and the financials look like shit. And they want to raise money. Where do they go? They all go to the US because the US gives the highest multiple for these kind of companies, right? So in other words, if you sell your shares in, say, Singapore, maybe, let's say Financial Coconut goes for listing and we're not very profitable, but we're growing very fast. And if we list in Singapore, we can raise maybe $100 million. But maybe if we list in the US, like BuzzFeed, we can raise like what? $3-5 billion, right? So it's a whole different multiple altogether, right? So the US market has always been that market to go for a lot of these tech companies, high growth. But it has proven that a lot of these tech companies or high growth companies, over time, they become dominant and become massive. So then it becomes a flywheel, right? As these companies get listed in the US, they make more money because they raise more money. With more money, they can go and grow further and they become dominant. And then more investors come in to try to own them. So it becomes a flywheel and more people will want to own the US dollar and buy stocks in the US market. So you see the beauty, I mean, you look at Grab, Shopee, Razer, some of the biggest companies that grew out of Singapore and the ASEAN region, they all list in the US or list in Hong Kong, like Razer lists in Hong Kong, but Singapore has a very low multiple. Southeast Asia, the multiple is shit, right? So people want to go to these kind of bigger places to list. But more importantly, you hear the flywheel. And that is the flywheel that China wants today. Because China wants to establish its financial markets now, right? So it wants to open up its financial markets, welcome foreign investors, and become the dominant currency, or at least one of the dominant currency in the world today, which they already are in the physical market. That means like people buy a lot of goods from them, so people trade with them a lot. But a lot of them are still using the US dollar as the benchmark trading currency. All right, but China is trying to break out the US dollar because, like we've established, if you think about it, what is the strength of a currency? The strength of the currency is how much things this currency can buy. Okay, so I can create a coconut currency, but you cannot buy anything other than coconuts. How many people really want to own this currency? Right? But in Singapore, if you have Sing dollar, you can buy everything. Right? So US dollar being the benchmark currency of the world, in other words, every new product, every new innovation, every new resource that is being traded in US dollar is reinforcing US dollar's strength. Right? So for China is very incentivized to grow its own currency now. because it don't want to reinforce the strength of the US anymore. It wants to play its own game. It wants to have its own cycle, and there is reason to want to be the dominant currency, because if you're the dominant currency, all the interest rates is pegged to you. You can tax, you can use sanctions. There's so many powerful things that you can do. So China is incentivized to do that. And because of the flywheel effect of some of these tech companies, of course it wants it to be in China, right? So when you bring all these tech companies back to China, hey, people are going to own Hong Kong dollars for now. Eventually, I believe Hong Kong dollars will fade out. There will just be one currency, which is the yuan. People want to own the yuan so that they can own these stocks. And then as these stocks become bigger, and the flywheel will, it will keep happening. And at this point in time, Chinese financial institutions and the Chinese capital is very, very big, very powerful. So a lot of Chinese companies actually don't really need to list in the US anymore, right? They can maybe get similar or good enough multiple back in China. Of course, that is not yet a reality now, but we shall see as this go along. Will this be the reality where Chinese companies get equally good multiple when they sell their stocks in the market in China as compared to the US? But the change is that now the Chinese companies, they have a lot of money, they have a lot of capital, and they want to invest, they want to grow themselves and what have you, right? So if you think about it, the underlying incentives for the Chinese companies to go abroad now is changing. Number one, because there's the stick, right? The government don't want you to do that. Of course, the carrot is also shrinking. The US is no longer as exciting. They want to bring it back to China, right? And the Chinese government have a big incentive to try to bring these very big popular companies to list in China itself, because then that will promote the Chinese financial markets. People want to own the yuan, and then the cycle, the flywheel happens, right? And then these companies, they raise a lot of money, they continue to grow, and then as they get bigger, more big investors want to come in, so you see the flywheel growing, right? Then yuan becomes a dominant currency, even in the financial market. So the incentive structures are changing, which is why to me, it is not a risk, it is just a new reality, right? You will see more and more Chinese companies directly list in China or Hong Kong, and may avoid the US markets altogether, right? And this is not a very big problem for all of you listening. I know some of you are concerned. I will say, why not you just buy from Hong Kong and Shanghai lah, right? You don't need to buy in the US, right? These days, a lot of brokerages give you direct access to H shares, which are the Hong Kong listed shares, and A shares, which are the Shanghai Shenzhen listed shares, right? So you have direct access already. Why do you need to be concerned? And some people will say, oh, because the liquidity is higher in the US. I really have to tell you, you are extremely small investor. Why do you need to care about liquidity? Right, liquidity is a big concern for big funds, for ETFs, and for big fund houses. Why? Because they are moving hundreds of millions of dollars and billions of dollars. Every time they want to move this kind of money, of course, liquidity matters, right? But for a lot of small-time investors like ourselves, you own one stock, 30K, 50K, 100K, like, why does it matter as much? Rather than sweat over that liquidity, why not just shift everything to China in itself, because you have direct access, and fulfill the China dream and also not be so concerned about, what if delist, all this, like, do you really need this extra headache? You don't really need it, right? Which brings me to point number 2, and that is delisting is a very neat and organized process by now. There's no real risk in this process. And we will talk a little bit more after a word from our sponsor. Okay, delisting from the US market is not new, and it's not like wow, suddenly delisting. No, a lot of companies list and delist and privatize and regroup and then list again. It happens all the time. Of course, some companies, they don't do well. Eventually, they exit, right? MySpace, or some of the companies, they do well, like Slack, and then they get bought over, they merge. Right, so that is also a process of kind of like delisting, or even LinkedIn being taken down. So you see a lot of these kind of listing and delisting and merging and being bought over and what have you, right? So it's very normal in the US, and it's a very established process. So it's not like some very risky thing. Oh my God, what if delist? What if nobody want to buy? No, it's a very, very established process. And the US is probably the most established and organized financial market ever, in the world. So why so concerned about it? Right? You don't need to be too concerned about it. And specifically for Didi, there's rumors saying that they're going to delist at $14. So they're going to buy back the shares essentially at IPO price. Right? So why so concerned? Why so you think China is going to do some foul play? Didi is going to be like, oh, we're going to buy at $6 because the current trading price is at $6. Like, how many investors will sell back at that price? Okay, you must understand that a lot of these investors, although it's not all institutional, but there are big institutional investors in the market, and they're not here to play around with you. Okay, they're not here to have fun and kumbaya. So they will not anyhow let you delist. If you want to delist at $6, I don't want to. I just hold on. I don't allow you to delist, right? And if China if the company in itself cannot buy back enough shares, then they cannot delist. Which is why even in Singapore, when a company wants to delist or when they want to merge, they always pay a premium. They always pay a premium so that the investors will be like, okay, let's sell it back. Right, so it is a reality, and delisting is a very organized process by far. And with the recent, Didi, I think I read it somewhere, is they want to take it back at $14. I'm not sure exactly. Don't mark me on this. But it is what it is, lah. Right, so it's organized, and people are gonna pay a premium to get it back. And China also does not want to make it sound like, we're gonna do very foul play and do that for what? What's their incentive? Their current incentive is to let you feel like, we are trustable, we are organized, we play by the markets, we play by the rules. That is what they're trying to make you feel. Right, so why would they do a foul play on you? If they will not do a foul play on you, then essentially, so what if the Chinese company delist? They will delist at a fair price, or they will delist at a price where you will accept, or at least the institutional investors will accept, because they need to negotiate with these guys, which is why TT is an easy target compared to some of the very established companies like Tencent, like JD, like all these guys, because they have a lot more institutional investors within them. In other words, they have a lot more institutional political power trying to control the companies, and not so easy to delist on the market. Right? So TT is easy target, right? Cheap, nobody wants it, everybody throw it. Okay, let's delist it, bring it back, and then fry it up. So delisting is a very common thing, happen again and again and again. Nothing to be too concerned about. I would say a lot of you probably when you're thinking about it, be like, what if the share price that I buy goes below? That's a different situation. Whether will it go below? At what price do you buy an IPO? Right? Are you chasing the price up when IPO times? Right. So either way, as long as you're an investor, you are subjected to market risk, right? But I would say it will not be a situation where it's like a shit price and they just want to force your hand on it, because it's not so easy to begin with. Right? There are very organized structures. Then some people are like, what if they just bypass the whole ADR structure and just say, this is illegal, and close it? Then you are very sure that there's a war happening already, so it's not so easy. There's a lot of pressure. It's not so easy to not just follow rules, or not just not follow rules. Okay, there are a lot of political pressure, geopolitical pressure, military pressure, and even internal pressure. Right? Why would you think the Chinese government is infallible? Internally, they have a lot of problems, and they have a lot of factions also. Right? So nobody wants to mess this up. Everybody just want to do an organized fashion and list it in China so that they can get the Chinese stock market and the financial market move in a flywheel effect. That is my view. And point number 3 that I think you should know is that the recent share price dip, looks quite serious, but it is highly likely a momentum issue, not so much a fundamental problem. So like I was saying about Omicron, or Rakesh and Rakesh and Anthony were joking about me on their show, TFC Market Updates. You should check it out on TFC Stock Geek Out. But yes, whatever name it is, it's probably not the main problem here. I would say interest rates very likely will move up, because inflation looks like it's not transient. It looks like it's going to stay. So with that in mind, it is essentially going to become a very big pressure point for the Fed to arrange their interest rates in a higher fashion, right, to kind of dampen this whole inflation problem. So with that, that is definitely an underpinning factor. And also the other underpinning factor is a lot of fear in the market. People are not sure about what's going on. So why not? In an increased uncertainty environment, you will see volatility move higher, and you will see more money moving out. Okay, so that is the reality. So I would say the recent share price decline with all these Chinese companies is a few things, right? It's the potential increase in interest rates, it's the potential uncertainty of what is going to happen in the broad market, but also with the US-China situation, people are not sure what is the situation now. So with a lot of uncertainty, people price that in. But at the same time, when you sell, it's a falling knife, right? So which is why it's called a momentum situation. Also because that is very well documented that with a lot of robots, with a lot of computers being in this game, as long as there's a sell, the sell moves a lot. It just keeps selling, because it just keeps triggering all the algorithm to sell. Right? Also, as long as there's a buy, it keeps triggering a lot of buy. So you see the volatility of the market in itself very, very high compared to maybe in the past. And yeah, so I would say this is highly likely a momentum issue. In other words, it's a hype issue. Like everybody do, then you do, lor, right? So the algorithm kind of follows along. So the sell becomes quite painful and quite serious, like, which I hear you, and I know that it's a problem that a lot of you are facing because, Christmas, CNY coming, then you see all the share price come down, you're very unhappy. I know, okay, I get it. But this is the reality of the market. There are a lot of things that you cannot control. So all the general ideas that govern your investment ideology, they stand, right? So diversify lah, invest long term lah, invest in what you know lah. All those things are say on this already, okay? But those are the reality of being in investments, right? And you don't want to over concentrate your portfolio in the Chinese companies, and if not, you get the brunt of some of these things that sometimes don't make sense, right? Because it's a momentum situation. There are no real change in the fundamentals, right? The Chinese markets are getting better and better. They're making more money in the hard economy, and also a lot of these Chinese companies they are serving the market very well. So you see their business growing, but their share price come down, right? So it's not about fundamentals here. It's really about the news, about the uncertainty, about potential increase in interest rates, and of course the momentum trade downwards, right? So very likely, if you start to see a more organized exit for TT in the next few weeks, you may see a very fast run up, or at least run to a more healthy place for some of these other Chinese tech companies. Okay, of course, maybe the news cycle will go into other things lah, right? They'll start talking about other things, then you'll be also be better. So yes, I hope that these 3 points give you a little bit more clarity about the China stock delisting situation now. It's not really a risk. I believe it's the new reality, and I'm gonna sum up the 3 points. Number one is Chinese companies used to list in the US because in that era where they had no money, they want to get a higher multiple, right? So same with Grab, Shopee, Razer. The local markets are not giving them the kind of multiple, so they want to list in the US. But China now wants to grow its own stock market, want to grow its own financial markets. What's the best way? Bring some of the high growth tech companies that they really like and the market really likes back home. So that is the new reality, and Chinese companies are less and less incentivized to list abroad now because locally I believe their capital is ready and are able to give them a decently good enough multiple that they don't need to go through this whole process to list in the US anymore. Number two is that delisting is a very neat and organized process, very well documented so far. I don't know why is there a risk for delisting, right? So it's very well documented. It's a very organized process. The US is a very established financial market, and China has no incentive to try to look like a foul player at this point in time. And point number three is as share price dip, it creates a momentum to sell, right? So I would say different people have a different pain-bearing ability, and with the market having a lot of algorithms, a lot of robots at play, the trigger is quite serious, right? So the dip is definitely a little more serious than the fundamentals. I don't know what's changed in the fundamentals. Fundamentals look pretty much the same for me, at least for a lot of the Chinese companies. I would say Alibaba may have a little bit of change, but that one we can have a discussion another time. But broadly speaking, I believe this is a momentum situation. Do not be alarmed if you are a more fundamental investor and you are here for the longer term, right? But short term is very painful, I know, I hear you. So I hope you learned something useful today. See ya! Hey, I hope you learned something useful today and truly appreciate that you took time off to better your life with the Financial Coconut. Knowledge is that much more powerful and interesting when shared, debated and discussed. Join our community Telegram group, follow us on our socials, sign up for our weekly newsletter. We are doing a weekly newsletter reboot. We're going to have a lot of information within the newsletter. Everything is in the description below. And if you love us and want to help us grow, definitely share the podcast with your friends and on your socials. Also, if you have any interesting thoughts you want to share, or you know someone that we would like to hear from, reach out to us through hello@thefinancialcoconut.com. With that, have a great day ahead. Stay tuned next week, and always remember, personal finance can be chill, clear, and sustainable for all. Okay, because you guys asked, I try to give you what I can, for this period, and I really think it's overhyped or not a real problem at all. So if you have any other questions that you want us to do, I cannot promise you that I will always do breaking episodes, but hey, if there are some things that are concerned enough and you think it's important to you, please let me know, and then we can have a good discussion. Join our Telegram group, talk on us on Instagram, email in hello@thefinancialcoconut.com, and what have you. Okay, so meanwhile, take care, have a good year end, and rest well.